Good morning, everybody. Thank you very much for joining me today. This is, I think it's about the 8th or the 10th in our weekly series with the COVID-19 update. Today I can't join you in person because I have to go to a specialist appointment. I've got a problem with my eye, so we've recorded this and I hope you get just as much value out of it as you normally do. I expect this will last less than 30 minutes. Certainly we're available afterwards to answer any questions you may have. Fortunately, we're in a space where things are starting to improve, and I think everyone understands that that's happening, so that's a good place. Today will probably be the last of our weekly webinars. We've got a bit of feedback from you. Thank you very much for filling in the questionnaire we sent out last week. We've found that people are enjoying them, so we'll continue to do them, but we're going to move this to weekly. Sorry, we move this to fortnightly. Probably in time moving it to a permanent monthly fixture because the feedback's been very positive. I hope it continues to be so. So let's get started. Today we're going to have a quick rehash on a couple of things, but I'm going to spend a little bit of time talking about causes for optimism and a variety of terms that you're going to see in the media. So again, quick virus update, market update, V, U and W shaped recoveries. That's a word that the media love to use now. It doesn't mean anywhere near as many complicated things as you think. So we'll get into that. And then we're going to have a discussion about the future. So housekeeping, it should last around 30 minutes. Because this is a pre-recorded session, we're not really taking questions. Although I hope Chris will be available after he's played the video to answer any questions. But as you know, please contact us. We're all available. The office is gradually offices are becoming repopulated. People are drifting back to work because as much as the work from home thing can work, it's not quite as convenient for us. But as I said, always, if there's a little bit of difficulty with sound, try turning your video off, your personal video off. Slides, as always, are available upon request. So, quick update on the virus things. I've tied a little bit of the constant graphs that we've been showing. This is a little bit similar, but you can see here, this graph's Australia's cases, relatively low comparison to everybody. China, about 80 or 90,000 cases. Not 100% sure their data's accurate. India's really on a strong growth curve upwards. We're seeing also Italy has recovered, but it's still nowhere near like China or Australia. And certainly you can get a sense here of things being swamped. Japan actually has had a very good response because the Japanese tend to be a fairly compliant people. Sweden is always an interesting one, along with Spain. They seem to have got things under control, although the Swedish have chosen not to enforce social distancing restrictions. United Kingdom's still not under control. The curious situation, of course, is when you compare all of us with America, it's insane. The Americans simply just have not respected the COVID-19 situation. They simply didn't do what they needed to. I think that applies to the government as well as the people. The irony, of course, is that the American situation, by comparison to these countries that we've just outlined here, it seems to be more than the rest combined. Now, in all cases, including Australia, there'll be underreporting of the number of cases because majority of people are not symptomatic or only mildly symptomatic. But it really is staggering when you look at the response of the American population, and obviously there's a lot of tension over there right now. Now, I came across this really interesting chart, which I thought was worthy of a bit of merit because it goes back to some of the previous seminars that we've given. So this chart sort of maps the countries that are at risk. So the countries with the best prospects are in the top right-hand corner. They're the ones where the country's getting back to normal, the infection rate's under control, it's all very good, and Australia's in that group. The worst prospects are the one in the bottom left-hand corner where the virus is out of control and people aren't allowed to get the economy going again. The ones where they're freely moving, but the virus is not under control are the riskiest countries, and there aren't many in that group, although Brazil's in there. And the ones that are the most cautious are the ones on the right-hand side. Now, there's actually a few things in these graphs here that present positive stories for Australia. So yeah, we find Australia here. The truth is our government has been relatively slow allowing people to go back to work. We're not even going to argue about that. It's just a fact. We're seeing this tension between, Queensland and Western Australia and the rest of the country. That'll play itself out over the next couple of weeks. Hopefully, we'll find some data fairly quickly by the end of the week around whether opening up the New South Wales and Victoria and Queensland states has resulted in the spread of the virus. If that happens, then they're going to clamp down again. That's just going to have an economic impact, and that's sad. Now, Japan and Hong Kong, there are two major trading partners, Hong Kong being a proxy for China here. China is considered to be well and truly under control. So the people are allowed to move again. The economy is looking very strong, and it's actually going to be a very positive story. Roughly the same thing for Japan as well. So that's a really good story for Australia. Our two primary trading partners are up and running again, and the level of optimism in the country is quite strong. Now, Italy and Spain are there just for reference. Things are definitely under control, but they're only slowly releasing the population to move around again, which is quite interesting. Now, these three countries, Brazil and China, I find really fascinating because, Brazil, Canada, and Argentina. Brazil is our biggest competitor for the subject of iron ore, and I'm going to come back to that in a little while. But they are very much an at-risk country where the virus is not under control, if you remember the graphs from earlier, but they're opening the country up. So there is a genuine risk there's going to be problems there, and China would be foolish to rely on Brazil's economy right now. Given that we export about 3 times as much iron ore to China as Brazil, and Brazil's the second largest exporter in the world, I think this actually augurs well for their dependence on our iron ore. Now, Argentina and Canada are our two biggest competitors for beef exports to China as well. And both of those countries are actually, just a little bit uncomfortable and not reliable. The Argentinians are in a worse situation than the Brazilians in terms of their recovery rates, and the Canadians are simply subject to the American effect. So if I was China or any country around the world, depending on the exports from those countries, you would not go, well, basically you wouldn't cut your nose off to spite your face. It doesn't matter what they're saying in the media. Australia is a far safer bet for some of their key exports or imports than Brazil, Argentina, and even Canada at this point. Now, we see America there. We all know the American story, so I won't go into it, other than they have a long way to go yet. United Kingdom, to be truthful, United Kingdom still hasn't placed restrictions on people coming into the country. Australia put the mandatory 14-day restrictions in place very early on. United Kingdom, I believe, is only applying that from this weekend. Excuse me. So they've actually had a very, I think if we're just going to accept that the governments needed to respond the way they have, the United Kingdom's had a fairly poor policy response to this. And I think they're going to suffer economically as a result. Now, with the Brexit thing and COVID-19, I think we're going to see a very aggressive monetary policy coming out of the United Kingdom, monetary and fiscal. Basically, they're going to print money and they're going to spend it like they're on a mission from God. And that's the only way they're going to get the UK back into a strong place, or the government will simply be blamed for the economic situation of the country, which is not unreasonable in many senses. So you can expect a very aggressive policy response out of the United Kingdom. We're already getting it out of the US. So economically, there are some interesting numbers here, and we're going to look at some graphs in a second to discuss that. But this is quite a fascinating chart, because I think Australia, when you look back to the right, our mobility is going to come back very quickly. And the other countries could be quite a while, but certainly if you're looking at putting in place 6 and 12-month forward orders on things like beef or iron ore, you're not going to depend on countries like Brazil and Argentina to the exclusion of Australia right now. That would just be bad policy, and I don't think we're going to see it. And I think we're going to see, if you look around here, we've got Netherlands, Sweden, Belgium, France, and even Germany down here on the bottom right-hand side. All of these countries are actually quite slow allowing their countries to restart. Now that's going to have a negative impact, and we can expect a fairly aggressive response out of these countries in the EU as to printing money and to spending money. So I think we're going to see a fairly positive response here, although my gut instinct is it's going to take another 6 to 12 months to fall out. So yet another positive week in the markets. The US market's back very strong, as is Australia. The interesting piece here is this date down here. This is when these George Floyd riots started. It's a terrible situation in America. And, you know, I think you hear me say it every week, but thank God we live in this country. I have nowhere else in the world I'd rather be, and nowhere else in the world I want my family to be raised, because we simply don't have the level of difficulty that America has. And it was a terrible video that was shown. Curiously enough, the stock market pays no heed whatsoever to the domestic problems in America. And that's a fairly positive story to take out of this, if nothing else. Now, the Australian charts, again, look very, very similar. So, you know, that's a good story. If you look up here, we're at 59.67 on the All Ordinaries. We're basically back to almost 6,000 points. This is a, by the time we hit the 6,000 point mark, I think we can just put our hand in the heart and say the COVID-19 element of this stock market correction is probably behind us. Well, I suspect we're going to have what's called a W-shaped correction, so we'll get into that in a little while later. But we're now back to where I suspected, and many of you, if not all of you, would have heard us talking about the probability of a bad year over the last year or two. Well, I think we're now back to about where that would have been. And I see that as a very positive thing. Interesting figures here. This is, many of you will have seen me talk about the LIBOR rate, the interbank over-the-counter rate. This is basically the confidence measure that the banks have to lend money to each other. It's a measure of interest rates, so they will charge interest to each other. But when things get dodgy, the rate goes up regardless of the prevailing term deposit rate that people are receiving. So we see it drifting down from last year. We saw a massive kick in the guts in March, April. It then took off a little bit when the trade tensions with China appeared, and this stuff will continue for a little while. But with the liquidity response, that is the printing of money, the banks are now extremely confident that they're going to be able to get money anywhere they want it, which takes away the risk premium associated with borrowing it. And, you know, we're seeing one of the lowest LIBOR rates in history, which is a very good thing in the sense that money's cheap, which is good for your kids borrowing money to buy houses. But also it illustrates a very high degree of confidence that the banks have in the next 3, 6, 12 months in terms of their ability to access capital. And that's a really important thing, because at the end of the day, in the GFC, this rate shot stratospherically up and was extremely difficult for banks and businesses to get money. Whereas in this case, we're seeing the banks extremely confident about that. Now, this is an interesting chart. It's what's called the Purchasing Managers Index. It's a measure of the business confidence going forward. Now, the dotted line is China, which took one kick in the guts and is now back up to almost positive territory. That's a really strong figure because it says that China is open for business and they need iron ore and coal and meat and all those things. Australia's got a more muted story. This is the blue line for Australia. We fell further and we're slower to recover. Now, I don't see that as necessarily a bad thing. I expect that's going to recover over the next 3 or 4 months. But this response out of China is largely mandated by the government. Businesses are doing as they're told, and they're getting back on a war footing, as it were. We see very similar story out of the US. The Chinese recovery very strong there in dotted line. The US bounce in the Purchasing Managers Index has been stronger. Now, there's 2 factors in there. Firstly, the Americans don't pay a lot of dividends out. So they have cash building up in their companies really quickly, and they need to do something with it. The Australian stock market has a history of paying dividends, and we like that as a nation, very much what I call a Jerry Maguire effect of show me the money, don't tell me what you're doing, show me the money that my company or my shares have earned. But the reality is, and I'll try to get some figures on this over the next couple of weeks, the reality is that there are huge amounts of cash available in the world at the moment, either being printed by the government or being stored in company or personal bank accounts. And as a result, we're seeing a fairly strong expectation that business is going to actually have access to capital and rebuild quickly. Certainly, there's what I call the tsunami effect that we're going to see in motor vehicles and housing and things like that, where people haven't spent much money over the last few months on cars or motorbikes or fridges or microwaves or televisions. And there is an embedded pent-up demand in all our economies for a certain number of these things every month or every year. So there's been a muted period here. We're going to see a strong recovery. And as Chris pointed out last week, there has been some strong retail figures coming through. I think we're going to see a change there, but it doesn't mean we're not going to see the spending. Now, oil. We all saw the figures a month or so back where oil was worth less than zero. The big problem with the oil market wasn't that it was cheap. That's a good thing, generally speaking, for the economy. The problem was that the American stock market, about 12% of the American market is linked to the price of oil, because after the GFC and after 9/11, the Americans made a very strong effort to be energy independent, which is how they introduced the fracking technology. So there's a huge number of American energy companies that are very dependent on the price of oil, and it needs to be above $30. They want it closer to 40. They'd love it at 50. And what we're seeing now in the blue line, which is a West Texas Intermediate crude line, which is the American oil price that we can lean on, is heading back towards $40. Now, I suspect that's a little bit artificial because of the need of the government in America to prop up the oil companies, but it's clearly there and it's permanent. The black line is the OPEC countries. And again, we're seeing what we need to see, which is a strong recovery in the oil price, which is necessary to protect the US bond market, which protects the US stock market, which protects our market. And so that was I won't say a bullet, it was just a risk that was well managed. So that's a good thing. Now, iron ore, I find this chart fascinating. So this is the iron ore price, month by month, going back from October last year. And what we're seeing is a very cyclical oil price. Sorry, cyclical iron ore price. So it clearly comes in waves. That's a pattern, and there's no problem with that. The bit that I find fascinating is from about the time China started to do its bully boy stuff, started to threaten Australia, the iron ore price has shot through the roof. Now, this to me is an indicator that China and the market doesn't expect anything out of China's strong language and response to Australia. The market is seeing this will be a combination of a couple of things, principally Brazil, I think, where the certainty of the iron ore exports are dropping, and you don't need to change the equation much in terms of supply and demand for the price to shoot up. But what we're seeing right now is strong prices for Australian iron ore, not weak prices. And given that China is the largest consumer of iron ore in the world, this chart very much belies the lack of truth in the way the media is talking about China and the impact on our economy. So the media loves a headline, they don't like charts, and numbers tell the real story. The headline just grabs your emotions. So if we look at this, I just want to finish today's session on something that's going to appear in your media a lot, and it's going to sound complicated, but it really isn't. And this is this notion of a U versus a V versus a W-shaped recovery. It's simply something that when economists explain once in the media, boffins just grab it and they run with it. So the notion here is that we have a stock market correction, right? So there's a market correction that comes in, and a few weeks later, the government responds with a stimulus of some kind. Now, in the U-shaped recovery, which is roughly what I'm showing here, it just takes months or even a year or two to work. The U-shaped recovery is, in many ways, a possibility, but it sort of doesn't quite respond to the reality that there's a lot of cash looking for a home in the world at the moment. So the U-shaped recovery, I think, is actually the least likely of the scenarios, but it does say that this is a big issue and we're going to see it take a while before the economies recover. The alternative scenario is what they call a W-shaped recovery. Now, the W-shaped recovery is the one I think that is the most likely, because it basically has the same thing as the correction and the government stimulus, and the stimulus works, but then more bad news appears and the government has to undertake another stimulus. This is the one I think that's going to be the dominant response, mainly because we haven't seen the end of COVID-19 in Europe or in South America, and certainly who knows what's going on in the US. Likewise in Australia, we're seeing the freeing up of movement, and that's terrific. But what we're not seeing yet are the economic impact of the shutdown. Now, I've said this a few times and I still don't see a need to change my view, that we're going to see a large-scale youth unemployment problem in this country for a little while, and it's going to take a fair bit of investment in our different businesses, our training industries, our trades, the tech colleges and things like that, as well as retail and tourism, to get these kids back to work. You know, we're going to see 15 to 20% unemployment in the youth market. Fortunately, everyone I talk to is seeing positive sort of stories. For the kids, for our children over 30, we're starting to see more confidence that their jobs are okay. But it's the younger ones where I think we're going to see a problem. So I think this is the most likely scenario, a bit of a W shape in Australia, but probably also around the rest of the world, because the market's going to recover because there's cash looking for a home, and you're earning nothing when you put it in the bank. So they're looking for any kind of return. However, this isn't over yet. This is going to take another 12 months to pan out. The biggest response, if they came out with a vaccine tomorrow and it worked, you know, maybe we'd see what is more optimistically possible, which is the V-shaped recovery, where it just works. Right? Not 100% sure that's going to happen, although we have seen it to date, but I suspect it won't be very long before we see another correction. And I know all of you out there, and this heartens me, understand that the worst thing you can do is try to get in and out, because we're simply not able to do that for you at the moment. It just takes too long to do it, and as a result, you miss the upside, and your portfolio suffer as a result. So this is a U versus V versus W-shaped recovery is simply a matter of it isn't quite over yet kind of commentary. Don't get overly stressed about what the media tells you. A W correction is simply an indicator that the bad news that we all kind of expect has arrived. And the government has not finished stimulating things. The government will be building new internets and building new roads and bridges. I'd like to see them building some of them in the Hunter Valley rather than Sydney or Melbourne, but c'est la vie. So I did look at the webinar Chris gave us last week, and I really thank Chris and Ryan for writing it, because I thought this particular slide was really quite a good one. So the recent bounce is fueled by capital, government spending, and also, you know, people believing that we're in for a V-shaped recovery. As I said, not likely. If the vaccine comes along, we're going to see strong recovery. If it doesn't come along, we're going to see the gradual reopening of our economy. I think we can all accept that we've really lost the education dollar from this country for 12 months. The Chinese will continue to stomp and wail, but we're going to see tourism and education be the real sufferers out of this market. I think, you know, my kids are all excited about the local drive-in opening up again on Friday, so we may be going to the movies on Friday. I'm keen as mustard to get back out there and go to the movies and things like that. My kids are going away this weekend because they're allowed to. So, you know, there's a lot of positive there. We'll see a slower recovery there, but we'll see a recovery. Retail seems to be hanging in there, although I don't think anyone doubts that we're doing a lot more online shopping, and there are going to be some changes to some big names like Myers and things like that going forward. But as I said before, the economic data isn't out there. Over the years, I've listened strongly to a lot of clients that own businesses, and they're all hanging in there. I don't know anyone that's actually in trouble economically. Some are a little more affected than others, but I know my local coffee shop they're quite happy. You know, they said there's just as many people buying coffee. They don't want to actually allow people to sit at the tables because it actually limits the number of people that can come into the store. But we are going to see some rough economic data, and it's going to affect sectors like education, tourism, retail, youth unemployment, and things like that. Now, the $60 billion figure, well, that was a calculation error, and it's insane for the politicians to say, oh, we've now got $60 billion to spend. We don't have $60 billion to spend. In our next session, I'm probably going to talk a little bit about about the bond market and how the government printing of money affects the bond market. But it's an absolutely churlish argument to suggest that they now have $60 billion to spend. That's just stupid. The truth is the government can't just keep giving people money. We want them to get back to work. It's not a matter of, oh, we've now got money to keep people on the dole for another year. That's not a wise thing to do at all. China will continue to be problematic, but China needs the world. And it needs the world more than it needs its ego stroke. So we're going to see some interesting stuff out of China and America. But just remember this, they may be bullies, but they need to trade. And we're the most reliable source of most of what they need in the world. And Donald Trump is going to be Donald Trump. So as you've heard me say it time and time again, cautious optimism. I think we're going to see a recovery. I suspect W is the most likely scenario coming forward because there's bad economic news coming up, and it will have an effect on the markets. But fortunately, the stock market isn't the economy. The stock market tends to jump ahead 6 or 12 months, and it looks past the bad news. So I suspect it might be a fairly short, sharp W, but I suspect it's going to be a W, not a dragging out U. So we all know this quote, it's a matter of knowing and understanding what the story means when the media tells it to you. I tire immensely of the manipulation in our world by the media and the politicians of the truth. Fortunately, the Australian consumer, the Australian voter is far wiser than the media gives them credit for, and that's why we don't really buy into a lot of the insanity. So cautiously very optimistic that we're going to see some good figures. Now, just a positive story to share. Laura, who's our receptionist in the Maitland office, has decided to leave. And so we wish her very well, but I'm delighted that my daughter Katie, who point blank refuses to allow us to take a photograph of her, has come to work with us. Katie seems to be settling in quite well, and she's working closely with Olga in the Maitland office at the moment. This is the best photo I've got of Kate. It was taken a few months ago in Japan when we were over there with her. Katie's been studying Japanese and intends to study overseas again when that becomes a possibility. But when you're talking to Katie, because she'll be answering the phone, say hi. She's a pretty bright kid, and I'm delighted to have her with us. Okay, so I hope you've got value out of today. I'm sorry I can't be with you, but I've got to go to the eye doctor, and if any of you look closely, you can see that my left eye is rather uncomfortable at the moment. So hopefully they can get that fixed and maybe scrape this pterygium off my eye, which is causing me grief. Look, we've had another good week. I know we've had some good feedback from you, so thank you very much for tuning in and listening. I hope you continue to get value from these sessions. I know we're enjoying giving them, and it's nice to know that we can feel connected with you in this very strange time. So take care. God bless. I hope your family stays safe. But it's been an absolute pleasure talking to you today. Thank you very much.